Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
RZLV, or Rezolve AI, is, well, it's probably the ultimate case study in modern market narrative warfare. You have this incredibly aggressive corporate guidance just colliding head-on with activist short-selling campaigns. And it's all wrapped up in the structural volatility you get with a high redemption de-SPAC. The price action in December 2025 has been, nothing short of explosive. It's a battle between the balance sheet and the income statement.
It is. And that volatility really defines the entire story here. Right after the announcement of that debt-heavy Crown Peak acquisition, the shares just plummet, over 10% on December 1st. Then you see this dramatic, violent reversal. A 37% surge on December 16th, followed by, another 16% gain on the 19th, and on significant volume, too. This really raises our central question about where RZLV is headed.
Right. So the specific question for debate is this. Does this recent massive rally signify the market's fundamental validation of management's high-growth strategy? Is it proof that a fundamental undervaluation was being corrected? Or
does it just represent a technical, sort of short-term market microstructure reaction? A phenomenon that's just masking truly unsustainable debt and, frankly, major flaws in the underlying quality of their revenue. I'm going to argue that the technicals are overriding everything else and distracting from a critical solvency risk.
And I'll be arguing that the price action is, in fact, rational evidence. That the decisive forward guidance management release fundamentally refutes the short seller's zero revenue thesis and proves that the upside potential is now finally outweighing the risks on the balance sheet. Look, from my perspective, the market is finally waking up to the profound value that's embedded in management strategy. Those huge upward moves we saw in mid-December were not irrational. They were a completely rational repricing event based on some very decisive forward guidance. RZLV projected revenue for the single month of December 2025 to exceed $17 million and, critically, raised their 2025 exit annual recurring revenue, the ARR, guidance to exceed $200 million. We have to just pause on that number, a $200 million ARR target that directly shatters the core short thesis that the company has no real revenue. If management gets anywhere close to that, the stock is currently trading at, roughly 2.5 times projected revenue? That is severely depressed compared to its AI peers. The strategy, including Crown Peak, is the engine here. It's about integrating their high-margin Brain Suite AI into 600-plus established enterprise clients to drive cross-sells with, exceptionally low customer acquisition costs.
I appreciate the focus on the growth potential, I really do, but I think that view completely misses the forest for the trees. While those top-line numbers are certainly aggressive, they feel deliberately designed to distract from the market's primary, I'd say, existential concern, which is financial insolvency risk. We saw the true market reaction immediately, that sharp 10% drop on December 1st, right after the Crown Peak deal was announced. Why? Because that acquisition came with a massive liability, roughly $150 million in debt, with just staggering interest rates cited in the 12 to 12.6% range. That translates, and this is a conservative estimate, to about $18 million in annual interest expense. That is a brutal, guaranteed drain on a company that's still, cash constrained and supposedly focused on growth. And furthermore, I'm just deeply skeptical about the foundation of this growth promise. The short thesis alleges the whole AI pivot is just marketing fabrication. It cites claims that the company's 2024 organic revenue was negligible, maybe less than $190,000, and derived from questionable sources at that, and that the Brain Suite is really just a low-value wrapper using existing models like ChatGPT. So this aggressive rally, it's not institutional conviction in that $200 million ARR. It's characteristic of a severe low-float environment, which was caused by the mass redemption of over 96% of the public shares during the de-SPAC. In a structure that constrained, small bursts of buying just caused these completely disproportionate price gaps. Let's anchor this discussion in the reality of the balance sheet. That $150 million debt is the fundamental constraint. It's a solvency ticking clock. You can talk all day about the $200 million ARR promise, but RZLV has to generate substantial, high-margin free cash flow immediately just to service that $18 million annual interest payment. And that's before they can even think about reinvesting in organic growth. The promissory notes they issued have critical maturity dates in 2027. In high tech, that is not a long timeline. If the cross-selling synergy doesn't materialize fast enough, or if they struggle to generate that cash, the equity phase is a complete wipeout scenario. Because refinancing this kind of high-cost debt will be incredibly difficult, maybe impossible, without just massively diluting shareholders. The Crown Peak deal from this angle, it just looks like high-risk leverage that puts the whole AI story second to just servicing debt.
I see the severe credit risk you've outlined, but I think focusing only on the debt overlooks the strategic necessity here and the leverage provided by the acquisition. That $150 million liability isn't a mistake. It's necessary fuel for an aggressive enterprise software roll-up strategy. They are shifting RZLV from a speculative, pure-play AI company, which is always prone to volatile valuation, into a more stable, diversified enterprise platform. Yes, the debt is burdensome, but the transaction immediately provides a revenue floor. It adds approximately $70 million in legacy, much stickier revenue. And more critically, the $150 million secures immediate access to Crown Peak's deep roster of blue-chip clients. We are talking about companies like Toyota, Unilever, and hundreds more. This is an investment that secures over 600 enterprise clients, ready for immediate cross-selling of the high-margin Brain Suite. The debt is entirely justified if it accelerates the company's path to that $200 million ARR target. It turns the $150 million from a balance sheet death sentence into a profitable strategic catalyst.
Doesn't that fundamentally turn RZLV into a debt-laden roll-up vehicle, which, completely undercuts the original bull case that was built on superior AI technology? If success now hinges entirely on leveraging acquired, low-margin legacy revenue just to pay off high-cost debt, then the quality of that underlying revenue becomes paramount. So let's talk about that legitimacy. The short thesis has consistently alleged that the company has been faking ARR growth by acquiring distressed or marginal assets to mask a profound lack of organic, pure AI revenue. Take the Vizenze acquisition. The Fuzzy Panda report claims the company acquired Vizenze, which was a financially challenged entity, and paid $44 million for a business generating only $4.7 million in revenue. That is an astonishing 10x multiple for declining sales. This looks exactly like a strategy designed to buy failing revenue, specifically to inflate the top-line figures and mask a deficit of sustainable organic growth. Management remains opaque on this, giving very little clarity on the specific breakdown between what is truly organic AI revenue and what are these acquired legacy streams. Until we get that clarity, the market is completely justified in applying a fraud discount to RZLV's valuation, regardless of the headline $200 million projection.
I'm just not convinced by that faking growth line, because it willfully ignores strategic necessity and the modern economics of tech mergers. While I acknowledge that paying a 10x multiple for a struggling revenue stream, $44 million for $4.7 million, sounds high on paper, the company framed this as a crucial acqui-hire. In the current tech landscape, acquiring the right talent and technology is often far more valuable than the existing revenue. The Vizenze deal was critical for securing top-tier talent and specific proprietary tech for visual search, which is absolutely mission-critical for their retail and e-commerce clients. It also established a necessary APAC headquarters in Singapore. In specialized tech, the multiple you pay for talent and a strategic regional presence often far exceeds the revenue multiple. The recent explicit management guidance of $200 million ARR, backed by that projected $17 million in December revenue, serves as the most categorical refutation of the core fraud allegation. You can question the quality, sure, but you cannot simply dismiss the magnitude of the reported growth that these strategic moves facilitate.
We can and should question the magnitude when we look at where this stock trades, and more importantly, how it trades. I just don't buy that the recent rally reflects pure fundamental conviction when the market microstructure is so fractured. We see an exceptionally high off-exchange trading ratio. Reports indicate the off-exchange short volume ratio sits at approximately 71.72%. This means the vast majority of turnover happens away from lit exchanges like the NASDAQ, often in private venues known as dark pools. While it's legal, such high dark pool volume fundamentally obscures true price discovery. It allows sophisticated market makers to execute huge orders without affecting the public price. So how reliable are those dramatic price moves from December when the majority of transactions are happening away from public view?
Its history as a de-SPAC. That 71% off-exchange ratio isn't necessarily evidence of manipulation. It's a structural inevitability for any retail-heavy, low-float equity. Let's be clear what low-float means here. The mass redemption of nearly 97% of the original SPAC shares removed almost all the public stock from circulation, leaving a genuine scarcity. That is the definition of a low float. Now, about the high off-exchange volume. This is overwhelmingly due to retail order routing, specifically payment for order flow, PFO. This mechanism has retail brokers selling their customer orders to wholesalers who then execute them off-exchange. They do this primarily to provide price improvement, getting the retail customer a better price, and to mitigate volatility on the lit exchange. So the price gaps, which are indeed dramatic, are primarily attributable to genuine buying interest reacting to that $200 million guidance. But that interest is disproportionately magnified by the extremely constrained flow.
Right, but the sheer magnitude of the off-exchange volume suggests that the market's true opinion is being concealed. If institutional investors were truly convinced that RZLV was worth 2.5 times forward revenue, we would expect to see massive conviction-backed purchases on the lit exchange, driving price discovery. Instead, the price action looks like technical exhaustion and forced covering against a backdrop of heavily managed order flow.
And yet, we have the counter indicator of the cost to borrow. If this rally truly represented a dangerous liquidity trap or a catastrophic short squeeze, the cost to borrow, the annual interest rate shorts pay to hold their position, would be spiking 50%, 100%, or even higher. That would indicate a genuine scarcity of shares to lend. Instead, the CTB remains relatively benign, hovering around 1.37%. That tells us that while shorts are certainly being forced to cover because of buying pressure and the low float, they are not trapped in a death spiral. The rally, while technically amplified, is fundamentally a reaction to the guidance, not a technical collapse of the short side. We've covered a lot of ground today on the volatile case of Rezolve AI. The fundamental tension driving the stock's trajectory is clear. The future hinges entirely on whether that $200 million ARR promise can translate swiftly into sufficient high-margin cash flow. And that cash flow has to be robust enough, not just to fund organic growth, but crucially, to service the hefty 12% interest on that $150 million Crown Peak debt. It is a fundamental race against the clock, a race between growth acceleration and severe solvency risk.
Absolutely. The market ultimately has to decide. Does it price in the severe credit risk based on the relatively short runway to those 2027 debt maturity walls? Or does the market accept the growth story as sustainable despite the underlying fragility of the balance sheet?
My conviction remains anchored in the strategic depth of the plan. The evidence of massive projected growth, coupled with the strategic rationale of the Crown Peak deal, that ability to cross-sell a high-margin AI product into 600-plus established clients, it all suggests the stock is fundamentally undervalued. And that justifies the rally we saw in December as a necessary market correction.
And I maintain a significant degree of caution. That technical volatility, while it generates excitement, is a dangerous distraction from the underlying balance sheet fragility and the questionable quality of the acquired revenue. The key question for me remains focused on the defensibility of the AI product itself and whether the company can successfully outrun its own capital structure before those maturity walls hit in 2027.
So the focus now shifts entirely to management's ability to provide verifiable proof. The next critical event for RZLV, which will really determine if management can provide the verification to either validate the bull case or confirm the bear case, is the analyst and investor call scheduled for January 13th, 2026.
Right. That call has to provide concrete clarity on the breakdown between organic AI revenue and acquired legacy revenue, and crucially, a detailed, defensible debt service strategy for the next 24 months. Until then, investors really just have to weigh the immediate, significant credit risk against a compelling but still unproven growth promise.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.